Okay, welcome everyone. I'm Rob Tetrault. Today's June 1st, 2020, first day of the brand new month here after 2 good months in the stock market. I'm live here today on the Tetrault Show. I'm Rob Tetrault, Portfolio Manager of Canaccord Genuity Wealth Management at the Tetrault Wealth Advisory Group. Fun to be here again today. Please take a second. You know what I'll do before I do anything? Reminder, folks, this isn't investment advice. I'm going to run the disclaimer quick. All right, there's the disclaimer for you guys. So we are live here at the Tetrault Show. I'm at Portage in Maine, 201 Portage Avenue. I'm right in my office. I actually set up a temporary studio here to record for the shows, and I also do my global morning update from here. I got the producer Diggs and producer Mox behind the stage today. Folks, those of you that were expecting to see Bruce Croxon, I humbly apologize. Bruce had to send his regrets this morning. So we don't have Bruce today. We're rescheduling for Bruce as all my viewers leave, but don't worry. We do have, I do want to run through some headlines today. It's going to be a briefer show, but I do want to run through some headlines. Specifically, I want to run the earnings, some of the earnings that came out. The Canadian banks came out. There's some big news happening in the world right now, as you guys know. I don't want to spend too much time talking about that, but there, south of the border is a new era, it feels like. Definitely some civil unrest happening there. In Winnipeg, it's sunny as heck. It's a nice day out. I got to golf on the weekend with with a group of guys. So it was neat to kind of get out and hit the ball around, and social distancing. Obviously, no water on the course, no nothing, but it was neat to get out and golf. My pool's also open. I saw my wife's, Michelle's side of the family for the first time since COVID. A few of them came over. It was my daughter's birthday on the weekend. My youngest, Aubry, turned 3. Feels like just yesterday she was born. My dad used to always say this, and I used to say, I am never going to say that. I'm never going to say that. But regardless, I'm saying it right now. They grew up so fast. She's the youngest of my 4 kids, Aubry, and she turned 3. So we had a little bit of cake and stuff, had the family over. More importantly, today, June 1st, first day of the new markets, of this new month in the markets. Some of the headlines that we were following definitely included Trudeau's promise today to rush $2 billion in for strapped cities. So this is more money that's going to work for municipalities. So we've already announced a ton of money in Canada for individuals, for businesses, for retail landlords, for renters. Anyways, and now this is $2 billion for municipalities. This was announced today. Another headline that came out today was the Reitman's line. 2 of them closed. So both Thyme Maternity and Additionelle brands, they're going to be closed. So this is a Canadian story that they're closed. I would expect, if you guys are out there watching this should not surprise you. But if it does surprise you, just remember, folks, that things are changing. Things are changing fast. The retailers are having a hard time competing. This is the Amazon effect. It's becoming tougher and tougher for companies, big box stores, to pay their rent and to compete with, what's happening with Amazon taking over. Amazon, not just Amazon, Walmart is doing it, Target is doing it. The e-commerce world, as both Steph Menard and Yvan Beaujoli so aptly spoke on my show a couple of weeks back. If you missed that show, folks, please go ahead and tune in. By the way, if you're watching now, please take a second, go to YouTube, subscribe to our channel, subscribe it. If you're watching this on Facebook, please take a second to like and follow us. We value, we're happy to have you guys as viewers, but we would also, you got to be in the know whenever the new show comes out. You want to be aware. New show's coming out. All right, boom, I'm aware. The Tetrault Show. Okay, some of the other headlines that came out. I'd like to talk, the main topic that I'd like to talk about today is specifically earnings, the earnings that came out last week. I want to dissect them in a way that I'm guessing none of you have seen dissected. There's what happened in the month of May. First of all, in the month of May, so let's go back February. February was a down month. The peak of the market was February 19th, right before the market fell. Second half of we'll call it the third of February. Month of March was down a lot. Month of April, big rebound, the start of that V recovery. Month of May, we continue to see that V recovery. It has not stopped thus far. It continues. We've now tracked above the 50-day moving average, which is a strong technical sign. I had a question online today asking me, how is it possible, Rob, that the markets keep making new, I'll call this an intermediate high, that we continue with the V recovery, given everything that's happening in the US and in the planet, I guess some would say. So remember that the market is a forward-looking instrument, right? When we're sitting here and there's unfortunately all the civil unrest that's happening in the US, that doesn't mean that the market can't see through that. The market does anticipate, and when I say the market, I'm using the colloquial we as the market, which is all of us that are buying and selling securities. The market is it's almost a living thing. You know, we refer to it as an active, breathing, living thing, even though nowadays, as Martin Roberge and Javed Mirza commented on our show a couple of weeks back, it is largely dominated by algorithms. So I think part of this today here, part of this last week, in a period of civil unrest, the market just keeps pushing higher and higher. The volatility is down. Oil prices are up. The high-risk stocks, such as casinos, airlines, cruises, they're all moving positively up. The hospitality industry is moving positively up. So that's a contrarian indicator to what you would normally expect. You would expect in a period of civil unrest and uncertainty that we're going through right now, you would expect those stocks not to do as well, and you would expect to see lows. But because the market is seeing right through this, so to answer your question, I believe it was Jim who emailed me earlier today. To answer your question, Jim, the market is seeing right through this period of unrest. The market anticipates it's going to end. The market anticipates that there's going to be a shaking hands of some sort, and we're going to, these protests will end, and the market will move on. People will go back to shopping and spending. And there was a headline this morning on CNBC, and I read it, and it was like the causes of this protest. So aside from the people being hurt and the people dying and all that, which is obviously very, very significant and devastating, you also have some economic causes as well, some economic impacts as well, because companies are not opening their doors. You have retailers that are straight up closing or not deciding not to open. You have GDP. You're going to have some GDP costs. You're going to have someone's going to have to clean up and repair and fix all that, and that's likely to come from taxpayer dollars in the U.S., and that's likely to be coming directly out of the population's pockets, which is taxpayers. So there's another cost. So these protests, although they're going to be expensive, and the market is seeing through them, and the market is optimistic about what will happen afterwards. Obviously, today, as I look at the screen, what did we finish? The S&P 500 finished up 11 points to 3,055. The Dow up 91 points. Oil finished up 4 cents to 35.53. Western Canadian oil, if we take a look at it, it was up 89 cents today, up to 29 bucks. That is a huge, huge, huge rally. The TSX Venture, it's been on fire, up 10 points to 563. The TSX itself is up 43 points to 15,236. Gold is down $1 at 17.50. Silver was up 30 cents, 18.80, and copper up 4 cents to 247. I've had a lot of question about bank earnings, so I'd like to review the bank earnings with you guys real quick. They came out last week. Basically, this is so confusing for everyone because it's very, very hard to understand and appreciate. How is it possible that a bank is down 60, 70, 80%, not 80, but I think 50 to 70% year over year with their profit or their earnings? So I want to explain that to you because I've had a lot of questions on it, and it's not simple. And I don't think I've seen a quality episode on BNN or any of the other kind of news, financial news channels properly explain what's happening here with the bank earnings. So I'm going to take a run at it. I'm going to try to explain it to you guys because I've done a lot of digging into this and I wanted to understand it better myself. First of all, earnings largely, if you count year over year, we're down significantly. So when you look at earnings for banks, I'm talking about the 5 major Canadian banks, Royal, TD, BMO, Bank of Nova Scotia, and CIBC. They all reported earnings last week. Now, the key number that you have to look at here is loan loss provision or loss provision on their loans from these banks. Because what happens is, although they haven't experienced loan losses yet, so this would be people defaulting on their loans and that creating a loss for the bank. Now, how would a loss be created on a loan loss? Now, generally, if you own real estate, and banks are quite good generally at appraising real estate and giving a value on real estate, there's not anticipated to be a ton of loan losses on straight up real estate. I own a house. They lent me 75% of the value of my home. That is a mortgage. I pay my mortgage every month. COVID happens. I can't make my payments. I default on it. The bank repossesses my house, and they will then sell my house, hopefully for the mortgage or a little bit more than mortgage or a little bit less than the mortgage. There's not anticipated to be a ton of losses there because there's always equity built into the price of a house, right? Whenever you get a mortgage, there's always equity built into that. So in this case, the loan losses that I think banks are anticipating is likely not to come that much from real estate. It's more likely to come from credit card loans, car loans, and any other typical loans. And for those, you would need to get defaults. And if you have a default and you have an asset that's worth less than your loan, that's when a bank cannot recover their loans. So the loan loss provision is historically a number that banks report. And you don't have to quote me on this, but I checked a few banks today, and they've all increased them dramatically. So the loan losses that they've put aside for these banks have increased dramatically. For example, the largest bank in the country had put aside last quarter $419 million. $419 million for a loan loss last quarter. This is January, February, March. Well, when Q2 hit, it's not January, February, March. It's December, January, February. When Q2 hit, they put aside $2.8 billion for the loan losses. $2.8 billion. So six times the amount that they had put aside in their previous quarter. So if you look at the earnings for the largest bank in Canada, the earnings came in at $1.45 billion. A year ago was $3.2 billion. Okay. Profit per share came in at $1.03. Analysts were expecting $1.65. That is what we would call a big miss. All right. That's a big miss because we were expecting $1.65. The profit came in at $1.03. 6 times the multiple for loan losses put on the side. Now the dividend's $1.08. Obviously they didn't slash the dividend. Where was the price a week ago today of the largest bank in Canada? It was at $82 per share. Where is it today? It's at $91 per share. The all-time high is $110. The point I'm trying to make here, folks, and hopefully you're gathering it, and if not, I apologize. I'm going to try to make it again. The point is that even though the market was anticipating a loss of about, I shouldn't say a loss, earnings of $1.65 per share, and that number only came in at $1.03, the market clearly loved that earnings report, because not only is the largest bank up, the second largest, the third largest, the fourth largest, and the fifth largest banks in Canada are all up dramatically in the last week, when most of the banks missed earnings. They missed it rather dramatically. So how did they miss? They didn't miss on straight up profit. They missed because they put aside a ton of dollars for losses, for a loan loss provision. So if you're watching this and you're trying to understand why bank earnings were down, estimates came in below expectations, and yet the stocks rallied last week, rallied a ton, anywhere from 7 to 11%. The bank stocks rallied last week. So it was a big bump. That's why. So the market was obviously anticipating something significant on the actual earnings, not discounting the loan loss provisions. That number didn't come to fruition. And as a result of that, the loan loss provisions is only really a number that's put aside for the future. So if I'm a bank CEO, I'm worried that there are going to be losses in the future because of these bank earnings. So these bank earnings, I'm therefore going to say, I'm going to put aside, in the case of the largest bank, $2.8 billion for future losses. And if they don't lose that $2.8 billion, that'll be right back on the bottom line at some point down the line. So I would say, now it's odd to look at the multiples that the banks used with respect to their loan loss provisions. So the largest multiples was 6 times. The largest bank in Canada put a multiple of 6 times more loan losses than they had in the past. Some of the banks only put aside twice what they normally put aside. So the scope was really wide. Some of the smaller ones put aside 2 or 3 times what they normally put aside, but the larger ones were 5 and 6. So it's not that there wasn't a general formula here. When Claude and I sat here and we talked about bank stocks, what was that, a month ago? No, 2-3 weeks ago. And we said, it's going to be interesting to see the bank earnings. It was interesting. But the problem is there's no magic formula for these earnings in a period of pandemic when we have no idea how many people are actually going to go bankrupt, how many Canadians are going to not be able to make their payments, how many bank repossessions are going to exist, how many credit card defaults are going to be. We have no real idea. And proof of that is that the 5 different CEOs of the 5 different banks have put aside 5 vastly different numbers for loan loss provisions for each of their 5 big banks. So not only do I not know, they're guessing at some level as well. Now, I would expect that their guesses are going to be accurate, given that they know their business a lot better than the other banks. And it does make sense that some banks have higher loan loss provisions than others because they might have different sector exposure. They might have more global exposure or whatnot. But it is still odd to see this huge difference in loan loss provisions. Now, I had Javed Mirza on the show a while back, 3 weeks ago, I think, and he made a comment that, Rob, the only big missing piece of this rally is Canadian bank stocks. He said Canadian bank stocks need to recover before I feel comfortable saying that we're done with the W, that this is actually going to be a V recovery. So Javed was on my show. He said that, and he said, I'm really going to watch earnings closely. And here we go. Since Monday last week, we've seen a rally of about, I said it's 7 to 10% or so on bank stocks in 1 week. And the drawdown now, so the drawdown, for those of you that don't know, is the percentage that we've fallen from the top, the peak, the high, to the point we're at now. The drawdown, and by the way, guys, if you're watching on YouTube, please take a second to subscribe to our channel. If you're watching on Facebook, give us a like and a follow. We're thankful to have you guys as viewers, but you want to be in the know. You want to know what's happening with respect to the Tetrault Show. The drawdown that we're seeing with respect to the Canadian bank stocks is anywhere from 17% to the kind of best performer to about 36% to the worst performer. So they are still down. Canadian banks, there are some Canadian banks that are still down 30-ish% from their high during this pandemic. A lot of the sectors have recovered. A lot of the sectors have recovered very nicely. NASDAQ is attempting to make new highs, new all-time highs. Canadian bank stocks, they just haven't moved yet, but they've started to move last week. So it's going to be interesting. I'm in talks with Javed right now. We're going to get him back on the show. I'm going to get him to kind of let me know what he thinks about this bank rally, and I'm going to get him to tell you guys what he thinks about this bank stock rally, I should say. But it's definitely an interesting movement, I'll say. Questions on bank stocks, guys, whoever's watching out there, please put them right into the comments. I'd love to hear questions on what you think. Bank stocks, a couple questions here. How long do they think the cushion could hold? This is a question from Leela. Leela, I believe you're asking me to recover the economy, the kind of ammo that the government has thrown at the economy. How long do they think the cushion will hold? I'm not sure if I understand the question properly. But I will say this: there's an expectation that the stimulus required. I would anticipate that what I've read in all of the Bank of Canada decisions is that they are willing and able to put more money at this problem. Absolutely. So the cushion will, if it doesn't hold, they're just going to put more money at this problem, which could include giving money directly to consumers like us, right? Individuals, giving money to businesses so that they can kind of stimulate and survive and hire people and grow, and then give money to, municipalities, governments, even a bond buying purchase program could also happen as well. So there's a whole bunch of ways that the government is going to continue to put money into the market. And I don't think, if the economy doesn't recover, if we see a second wave, they're going to be willing and eager and able to continue to put money at that problem, just like we're seeing in the US. We're seeing that in the U.S. A lot, and we're seeing it a little bit more in the U.S. than in Canada. But regardless, the idea is that they've announced, which is a rare move by the U.S. Fed, but they've announced that they're willing and able to put whatever dollar signs at this problem. Leela's referring to the 2.8 billion. There's a question here about what happens to the market when the government stops funding. That's a good question, Michael. There are theories on this abound. The concern, I think what you're raising, the concern is that printing of money, eventually you get inflation. If you just keep printing money, you get inflation, more dollars chasing fewer goods. And if you get hyperinflation, that's extremely unhealthy for an economy. You could also see a rise in interest rates, and that then you could kind of have the reverse effect in that people are not able to pay their mortgages, etc., because the debt is so high, and you could see kind of a situation where a recession would happen. That's in theory, and that's what some economic textbooks will tell you will happen. I think if you were to look at what the Bank of Canada has said, they don't believe that's going to happen because we're in a position right now where there's so much unemployment that hyperinflation is not likely to happen. You can't have hyperinflation if you don't have dollars in our pockets chasing more goods, right? So inflation is always more dollars chasing fewer goods, right? If we all want to buy the same hockey stick for $100 and there's only one of them, it's going to be inflated in price, right, over time. So I don't think the Bank of Canada would tell you that's not a concern. I'm not worried about hyperinflation. I can guarantee you that. I think they're largely doing the right thing in spurring the economy here. There's a debate, and I don't want to get into the details of how they've done it, but largely they are putting dollars in the right spots, and both the U.S. and the Canadian government are kind of doing what they think is mandatory. I also question some of the timing on some of the moves, but regardless, largely it's been really good. There's a question here from Norman. Is it time to buy bank stocks? So Norman, I'm going to remind you, I can't give investment advice on this show. I would say that if your investment horizon, not you personally, if someone has a long investment horizon and they believe that there will not be massive defaults in the Canadian economy, and there will not be massive bankruptcies, and there will not be massive number of Canadians, not able to make their payments on their credit cards. If you believe that, and if it fits within your investment policy or your kind of asset allocation mix, and you're comfortable owning Canadian banks, it could be a time, depending on your horizon, to own Canadian banks. How to not answer a question by answering it? No, you really should be talking with your investment advisor about that, Norman. It's to say for sure Normand. It's not Norman, but thank you for the question. I think with all questions, with everything here, this is such a fickle, volatile time. I think no matter what, before you make any moves in your portfolio, I think now is a great time to be talking to your investment advisor. Take a look at your asset allocation. We've rebounded a lot here. I did also want to talk about casinos. There was an article this morning on CNBC. It was referring to casinos. Not sure if you guys followed this one or not, but some of the casinos are going to be opening this week or next week in Vegas. Caesars, I believe Caesars Palace, Caesars Entertainment is opening up this weekend. There's also, those stocks have moved a little bit. Remember, they fell a ton. Nobody wanted to buy a casino stock. We talked about it on this show a few times. Now the early numbers are coming out of Macau. The gambling revenue is down about 93%. I saw a report this morning on CNBC. The gambling revenue is down 93%, which is a stunning number to be down. Your top line revenue down 93%. Just a lot. Now, the question is, again, with those stocks, same thing as the bank stocks. If you believe that people are going to go back, and people are going to go back in the casinos, and people are not, apparently the first word out of Caesars Palace is that there's just so much activity and so much demand for people wanting to go to Vegas this weekend. I was a little surprised by the amount of demand. I'm in Winnipeg here. We've had very, very few cases in the last 2 weeks. I can kind of understand why someone would maybe want to go on a trip and travel. But remember, you're going to have 14 days isolation on the way back. It's going to be heavily intensified with personal protective equipment, masks. It's not going to be the same experience. And I keep thinking about all the people in Montreal and the epicenters, New York, and where they have a lot of cases. I can't imagine they're thinking of going to Vegas right now, but apparently there's a lot of attitude and appetite for going to Vegas this weekend. Surprisingly, I thought I was awesome by getting out of my house and going to the golf course, but some people are going to Vegas. Friendly reminder, guys, that I do this weekly now. This Tetrault Show, I did it twice weekly during the period, the peak parts of the pandemic. This show is a weekly show, Monday 4 p.m. Eastern, 3 p.m. Central. I'm happy to answer any other questions you guys might have, specifically a headline that you saw that you're not sure. Someone asked me about the Laurentian Bank dividend cut. So none of the large banks cut their dividend. Obviously, none of them have cut their dividend since the 1800s. The 5 biggest banks in Canada have not cut their dividend since the 1800s, or ever, I guess I should say. Well, I shouldn't say ever. I believe it's the 1800s, mid 1800s, I want to say. So those are pretty strong track records of continuing to pay a dividend. The dividend yields are now fairly high on the Canadian bank stocks, Norman, to answer your question. Nice fat yield you can get there if that's of any interest to you, if that makes sense in your personal situation. I would not anticipate a Canadian bank would cut their dividend. I've said this on the show many times. I believe those dividends are safe. I don't believe a Canadian bank will cut their dividend. A large Canadian bank, a big 5, I'll call it, because we saw last week or 2 weeks ago, Laurentian Bank actually cut their dividend. The CEO said it was out of, I'm paraphrasing here, and I just saw the headline, but I believe it's something about an abundance of caution and just being cautious with respect to the balance sheet of Laurentian Bank. So that's something that I certainly didn't expect. We saw a lot of Canadian oil and gas companies cut their dividend as well. Any other question, guys, with respect to this? Otherwise, I'll wrap it up here. I am watching. We finished up about 100 points, first day of trading in June. A good month behind us, the month of May. I'm excited about the summer. I'm excited about the reopening. Phase 2 in Winnipeg started today. Phase 2 reopening. So that is, gyms and more restaurants. And obviously it's a different approach, but it's exciting to see that happen. Be careful out there, guys. When you're out there, make sure to follow all the protocols and the distancing and the masks. And we do not want a second wave. That's not going to be fun. You recall when I had both the virologist and the infectious disease specialist on the show here, they both mentioned that in their mind, a second wave was not only coming, they thought it was inevitable. I believe they used the word something like, it's coming, it's going to happen. There will be a second wave in the fall. So just be careful about that. We want to kind of keep that under control. I'm going to stop it there for today, guys. So thank you so much for watching. It was a short show today. It was a last second show because we lost our guest for today. Glad I was able to fill you guys in on bank stocks. If you have further questions, please don't hesitate to go to www.speaktorob.com. Happy to book a no obligation consultation for you. Go to YouTube, subscribe to our channel. Please go to the Facebook page, like and follow us. I will be back 1 week today. Diego, who are my guests again next week? Should be able to pull them up here. I'm managing director, real estate, Luciano Diorio. Yes, he's a chartered real estate broker. He's in Montreal. So I'm really, really excited to get his wisdom, his piece of advice with respect to what's happening in the real estate market in Montreal. I'm super curious. They're having a lot of issues controlling the COVID. So I'm curious what's happening to the real estate out there. He'll be on the show Monday. So really excited. And then we're going to be working on bringing in some other guests as well. So please stay tuned, guys. Thanks for tuning in today. I'm Rob Tetrault from robtetrault.com, portfolio manager here, Canaccord Genuity Wealth Management, and at the Tetrault Wealth Advisor Group. You guys have a fantastic Monday, and get outside if you can. If you're in Winnipeg, it's really nice.